Great. Our next presenter is going to be Greg Genovese. So let me bring him up on stage. Greg, I see you here. I'm promoting you to panelist role now. And Greg is a really old friend of mine, or old in the sense of the Opportunity Zone initiative. He was one of my very first podcast guests. I think it must have been like episode 4 or 5 or something like that. I'll try to look it up while he's talking and post a link to it. But he was on my podcast back in January of 2019, right when I was starting to get that underway. Greg has a pretty good track record with OZI developments. He previously did a development in Bremerton, Washington. Hi, Greg. I can see you now. Good to see you. His latest fund, which I think this is the first time you're really publicly speaking about it. Actually, it's just getting underway now. Is going to be a first of its kind Opportunity Zone fund that allows the investor to choose from a portfolio of projects for as much diversification as they desire, or as little, for more project concentration, kind of a hybrid between a project-specific fund and a multi-asset fund. And Greg's going to go into much more detail on that. So, Greg, hello. How are you doing today?
I'm doing fine, thank you. I will admit, it's my first time doing a presentation like this. So number one, can you hear me okay, Jimmy?
I can hear you fine, and I can see your screen all right. Your slide deck looks good. So, Greg, I'll turn the floor over to you. Take it away, please. Thank you.
Thank you, Jimmy. And if I could just make one note to the audience and to you, I am having a little bit of trouble with my Zoom camera. So if my voice is on track, but I think my camera is off a little bit. So if your audience can please just hang in there with me, I think there's about a 3 or 4 second delay. So with that, I'll jump in, but you may not see facial expressions and actions coordinating quite properly. So I beg your forgiveness for that.
That's all right, Greg. Yeah, we can, there is a little bit of a delay, but we can see and hear you just fine. So please proceed.
Okay, thanks. Thanks for the introduction. And I want to give Jimmy and all the panelists my thanks for the opportunity to present to everybody today. My name is Greg Genovese, and I'm the founder and CEO of a company called USG Realty Capital. I'm now in my 31st year in real estate securities, and have been involved mainly in the non-traded real estate investment trust world, mostly the Reg D offering world, and the securitized 1031 exchange world for many, many years. And 3.5 years ago, I got involved in the Opportunity Zone initiative, strictly or initially as a researcher, and developed a company to come out with a program up in the Washington state area. And we built that platform, and we were very honored to be awarded by both Globe Street and Real Estate Forum magazine as the #1 Opportunity Zone fund and project in the country. During that time, I came to know a very good company called OZI out of Olympia, Washington, and the people that run in OZI are top quality financial analysts, developers, project managers. And so together we formed a joint venture called USG OZI. And through our experience over the last 3 years in developing Opportunity Zone projects, Opportunity Zone funds, going through the compliance and regulatory oversight community, which is really the area that we focus on, we wanted to get together, and we developed over the last few months a one-of-a-kind, first-of-its-kind type of Opportunity Zone fund that really allows the investors to have as much diversification or as much project concentration as they want. So it's the very first investor-directed Opportunity Zone fund in the country. So I'm pleased to present that to you today. And it's called Investor's Choice Oz Fund 1, and it's a $50 million project-specific series offering, and it is expandable to $100 million. And let me just jump right into it for everybody. I plan on covering 5 areas today, actually 4 with Q&A. I'd like to introduce our company and our partners. I'd like to talk a little bit about what we've seen pre-COVID in the investment environment for Opportunity Zones, and also post-COVID and what that investment or environment looks like. introduce you to our USG OZI strategy, and then introduce you to the fund itself, and then open it up for Q&A. As I said before, my name is Greg Genovese. I'm the founder and CEO of USG Realty Capital. My counterpart over on the Aussie side is a gentleman by the name of Kyle Weesey. He's the founder and managing partner. And I'll just let you look through all the names. I won't read them all off to you. But the idea behind USG OZI is my expertise and the expertise of the USG side is really on the real estate security side, the compliance, the asset management, equity raising side of the fence. And OZI is really on financial analysis, project management, development. And so between the two of us combined, we feel we really do make a best-in-class team. Combining our expertise, we've noticed over the last 3 years that what was lacking in a lot of the programs was really the risk mitigation and oversight of the programs. What we've decided to do is to develop a protocol and a proprietary risk management platform that can combine, as you could start from the left to the right, product development, building a best-in-class product for the investors with financial analysis, and then going into project and construction development and financing, and then overlay that with our risk mitigation strategies. And then comes in our compliance and oversight. And we can't get away from the fact that one of the main initiatives of the Opportunity Zone platform is, in fact, to create a positive social impact. One of the things you're going to learn during this presentation is that we're one of the only, if not the only, program in the country that employs not only a tax opinion for our investors on the fund and on each one of our projects, but also a social impact study that can actually demonstrate to the US government how accretive our programs are to the local community, combined with third-party reviews so that we have proper oversight of even ourselves. As most of you know, there are 3 types of Opportunity Zone funds out there, primarily. There are the big blind pools, which a lot of us saw in the early at the end of 2018 and early 2019. The large funds that were raising anywhere from 500 million to $1 billion or even more. In those funds, we call those blind pools because you really don't know where the money is going. You're really trusting it as an asset management model. On the other side of the coin is really the single project funds. And that's really where OZI and USG come into play. This happens to be the protocol that we believe best suits the investor. Investors today want to see, touch, feel, understand the pro formas. They want deep due diligence on the projects themselves. And so we're an advocate of the single project investment protocol. And then there are the multi-project programs, which may have anywhere from 4 to 5 to maybe up to 10 different projects within the corpus of the fund itself. So when you invest your money, you're actually investing in all of those programs. What we decided to do is to try to put together the very best of the diversification that the blind pool will allow you, meaning you can go nationally with your investment, with the specificity of each one of the projects, which you'll get in the single project, and combine it to allow for a multi-project investment. So we've developed a new type of Opportunity Zone fund, which we like to call it's a multi-project investor-directed fund. And we call it Investor's Choice Oz Fund 1. And this will be a series offering, which will have anywhere from 4 up to 8 to maybe even 10 different investments in the fund itself before we move on to the second fund. But again, we allow the investor to actually look at all of our due diligence and choose the projects they want to go into, including the amount of money they want to invest in each project. I'd like to talk a little bit about pre-COVID and post-COVID. The single project Opportunity Zone funds really were starting to take the lead just before COVID hit in March of 2020. But what's happened since that time is investors are now looking for more diversification. What was a benefit of looking at one project, the investors today are really a little skittish to go into just one project because of the diversification issues. There is a great amount of uncertainty ahead, obviously in the United States with the presidency and a lot of infighting going on in government. And so we really don't know which way things are going. And this actually leads us to believe in our thesis of a multi-project self-directed program that gives the investor the ability to pick their own projects. And I'd like to give an overview of what the current economy and investment economics look like. If we all recall that the stock market has actually been doing very, very well. And we have an environment right now where the stock market is at an all-time high. So we have very high valuations in the stock market, yet the risk in the stock market, as we all know, is much greater. Also, you look at the interest rate environment in the country, we are currently at historic lows. So put those two together, we're at an all-time high in the stock market, we're at historic lows in the interest rate market, and it doesn't look like interest rates are going to be moving anytime soon off of the low interest rates that we are getting right now. Also, I'd like to point everybody's attention to the current valuations in real estate. Believe it or not, COVID has actually afforded the real estate investment community one of the very small shimmers of light that COVID has allowed is the fact that the valuations have stayed very stable through COVID. And we may have felt we were at the top of a market, but because of COVID, we've been able to elongate our investment cycle. But be that as it may, cap rates around the country or valuations of real estate are at an all-time high right now. I'd like to draw your attention to the 2001 side of this graph and also to the 2008 side of the graph. And you'll see that that's where we had our last two recessions. And so when we had those recessions, you'll notice that valuations were quite high. So if it were pre-COVID, I would be on this call telling you that we are in pre-recessionary, we're in pre-recession, or we're heading towards a risk of a recession. That's probably not the case right now, but could very well be the case during your 10-year hold of an opportunity zone fund. So if you look at where we are currently in the real estate cycle, OZI and USG believe we're in this sector here, which is stage 6 or after that stage 1, either a late stable or early downturn stage, which may be elongated for the next six months to a year. So putting that all together, what do we actually see? We have an all-time high in the stock market. We've got an all-time low in interest rates. We have high valuations in real estate, coupled with a late stage in the real estate cycle, where there's a demand for opportunity zone benefits. It's our opinion that the pro formas and the investments that investors get into in the qualified opportunity zone arena should be as safe and preserve one's capital as best they can and be able to weather the storm of one or maybe even two recessions. Because again, we all know we have to hold these investments for 10 years. So you can't really look at each one of these investments from a 3 to 5 year period of time. So in the post-COVID environment, we have a demand now for increased risk mitigation, and it's led to a shift towards multi-asset funds and stricter compliance and oversight throughout the life of the program. And again, as I mentioned, all-time high in the stock market, interest rates are low. We're at a high in the investment cycle. We're towards the end of the cycle, greater uncertainty. And what this has created is a demand for safer returns in a tax-advantaged alternative investment, because as most of the people on this call probably are looking for, it's tougher and tougher to get double-digit returns in some of the more traditional liquid investments like you can in mutual funds, etc. So if you can take the extraordinary returns that a development project can give you your tax advantages in the Opportunity Zone initiative, and also mitigate that risk, we believe that's a model for success for a safe, secure return for our Opportunity Zone investors. And what I mean by that is our strategy is just this. It's 6 simple steps that we go through to mitigate risk and maximize return for our investors. And I won't go through the whole thing in detail, but we do have this 6-step process, from project sourcing with our partners like Colliers International, our developer network, where we do our developer due diligence and initial pro forma analysis, going into step 2, where we believe very strongly that the demographics are really going to drive the success of the Opportunity Zone investment, and not just by asset class, but also by the local economy. So it's just as important, in our opinion, for the investor and for us to do our research on the demographics of the asset class, the demand for the asset class, but also how can that local economy weather a recession or two over the next 10 years, and is it in an area that is being supported by the local community. Once we get past that, we can move into doing our finalized pro formas, budget, maximizing investor return, and then looking at our HUD financing through, again, some of our financing partners like Colliers, who will do the majority of our construction financing. And then we put this overlay through our risk mitigation stress test. So we want to see if our models actually make sense. We go through recession modeling. We then look at the area that each one of our investments are in, as far from a forecasting standpoint on the economics. We look at different cap rate variances to make sure that we can withstand and making sure that our modeling is proper. And then we forecast what our permanent financing will be in the project. Moreover, and I think this is an important point for the group, we're not actually going to developers looking to raise money for the developer. It's really the other way around. We actually have this protocol, the USG OZI strategy, in which developers will come to us and they have to fit our model from risk mitigation, recession modeling, cap rate variance, and if it meets our model, we'll then take a strong look at putting them into our platform. So it's a little bit opposite of the way a lot of programs are run. And then the last 2 sections we believe could very well be the most important, and that is from the standpoint of every one of our projects and every fund will have a third-party review. We also do a tax opinion to make sure that our investors and the fund is going to meet the twice-a-year asset test. And it's also done on the project and the fund itself. And then, as I mentioned earlier, we will be doing ongoing social impact reporting so that we can actually show an accretive value that all of our projects and the fund is adding to the local communities. And then lastly, we are a real estate securities group. So we have the oversight of the SEC and FINRA, and we also institute what we call project accounting and review between ourselves and our development partners to make sure that the budgets are in line and they have our approval for all draw requests and all construction costs. So we're not allowing necessarily the developer to do whatever they want and to use our money. We actually have control of that process, but we do it in conjunction with the developer, including an oversight committee, and then we do ongoing third-party reviews throughout the life of the program. To give you a sample of some of our current projects, we've stuck mainly to demographics that support high growth rate in populations, areas that have stable economics with major companies or major state or federal governments. And we also like to stay in communities that combine that with local education. A lot of our areas have major universities and colleges that support the growth either of downtown or student housing. These aren't student housing projects, but they do support student housing. So let me give you a sample of 4 of the projects that are currently in due diligence in our program. This is a 3-project program in Olympia, Washington. This is in the historic downtown, and Olympia is the state capital of the state of Washington. It's also the home of the regional headquarters for Deloitte and Touche, one of the top accounting firms in the country, and also local colleges, St. Martin's and Evergreen State. Olympia has a better than average population growth of a little over 6% per annum. This is actually a $7 million equity raise with project costs of about $61 million between these 3 projects. This is 207 units, and it sits atop, all 3 sit atop commercial space and also parking. And we have preferred annualized returns on this particular project of 12%. However, our pro forma has a 14% annualized return on this project. Second is in Milwaukee, Wisconsin. This is just 1 mile from downtown Milwaukee in the highest growth sector of the city. 77 market units. We have Colliers International, who is doing the financing on this project with us, and that'll be a HUD financing. $5 million equity raise, and we project $20 million in project costs. And we also have preferred annualized return of 12%. And this is also performing at 14% currently. So our pro forma is ahead of what the preferred return is now. And we are looking at HUD financing on this project. Third, Rosamond, California. You may not know that name, but if you've heard of Edwards Air Force Base in the Inland Empire in California, again, one of the fastest growing urban areas in the country, big population growth, high housing demand. This is called Sierra Creek. It's 248 units. It's a $20 million raise and $75 million in project costs. We have preferred returns of 12% on this as well. Pro forma on this is actually 13%. So again, our pro forma, and I must mention to you that our pro formas are actually done at decompressing the cap rate. So our pro formas, you'll find when you do your due diligence, are as conservative as they come. And then lastly, something a little bit different, but we're really excited about, is in Excelsior, Missouri. It's just north of Kansas City. And this is an assisted living, senior living facility, 145 units. And it's next to a historic hotel called the Elms Hotel. And so just adjacent and actually a part of the hotel. This is a $10 million equity raise, $41 million in project costs with a preferred return of 12. And currently the pro forma is at 15%. So just to give you an example, we have these, I want to give you a sample of a portfolio. These are made up people, the Smith, the Jones, the Hansons, and the Downs. And if you were to take those 4 projects, all would have tax opinions, all would have due diligence and third-party reports, all would have social impact reporting. And you can see the Smiths had $1 million to invest and decided to go with Olympia, Milwaukee, and Reno in varying amounts to invest their $1 million. Then you had the Jones, who went across the board at $100,000 a piece for $500,000. And then Hanson, we do have a low minimum of only $50,000 per investment. They had $100,000 to invest and decided to go into the Edwards Air Force Base, a Rosamond investment, and Excelsior for $100,000. And it is not atypical because we do have a long history with the family office channel and individual investors. And by the way, opportunity zone funds can invest in our platform through a special platform we've developed called PLI, Project Level Investor. So if any of the investors out there have their own opportunity zone funds and like our projects or our program, we can facilitate that. And so the last one is a $3.5 million investment. And you can see how it allows the investor to individually pick their investments within our portfolio. And every day the portfolio is growing. So if you look at the comparison of the different funds, blind pool, multi-project, single project, and then our platform, Investor's Choice, you'll see blind pool will give you diversification, and sometimes it'll give you regulatory compliance. Multi-project will give you diversification, some regulatory compliance from time to time, maybe even social impact reporting. Single project gives you just about everything you're looking for. However, it's concentrated, and so you have your eggs in one basket. In our platform, we not only give you multi-project diversification, but again, we allow you to direct your investment. I'd like to introduce you to some of our partners. DLA Piper is our real estate securities and offering memorandum legal and counsel. UMB Bank, these are all large companies, as you know, is our escrow agent and fund account. Colliers International is our partner on the financing side. We also have fund auditing done by Mosaic Financial Group, and then third-party reporting by Mick Law. And to give you an overview of the program and the offering, it's a $50 million offering, expandable to $100 million, $50,000 minimum investment. We do have two types of shares. We have what's called the A share. For those investors who want some cash flow throughout the program, we call this our income and growth share. We have a preferred return of 11% and a 5% cash flow, which is accrued and distributed once the projects hit stabilization. And then we also have our B shares, which are those who don't need the cash flow but want a higher preferred return at this is at 14%. And then you'll see from our return distribution chart, we put our money where our mouth is, and that is we don't get a return split with our investors until you investors get 100% return of your capital. And then it moves to a 90-10 split, 90% to you, 10% to us, once we've hit return of capital until we've met the preferred mark of 11 and 14%. And then it's a 70-30 split. And then if by chance we do 115% better than the preferred returns, it's a 50-50 split between you and us. Most likely it'll be between the 70-30 is probably the most likely scenario. With that, I think I went through it fairly quickly. What I'd like to do is just mention two things before you get back on, Jimmy, and ask questions. I do want to make mention that our hold period, two elements of the program that I think are really exciting, aside from the fact that the investors get to pick their investments, and the fact that it's all third-party reviewed, tax opinions, is we do offer a liquidity provision once we hit stabilization of anywhere between 90 and 100% of the investor's money. And you can read that in the offering memorandum. And our hold period doesn't necessarily have to be 10 years. One of the nice elements of the way we're doing this project or this program is that if we should want to sell a project with a great return in 5 years, the program is allowed to do a 1031 exchange of those gains into another project within the corpus of the fund. So I'm not saying we're going to do it, but it gives that variability down the line if it's best for the investors. So it's not a hold and you can't do anything till 10 years type of program. With that, I'll throw it back to you, Jimmy, and thank you. I'm sorry about the lag in my camera.
Oh, that's quite all right, Greg. Thanks for the presentation. Very cleverly structured, this one, allowing for, as is in the title of the fund, an investor's choice, a self-directed opportunity zone fund. Really clever there. We do have a handful of questions, and we're going to cut you loose here in just a few minutes, Greg, and then we're going to break for lunch because I'm sure a lot of us have to grab something to eat, take a little break, and we'll get back here at 1:20 p.m. Eastern time. But to get us started with the questions, Francis wants to know, do you have any projects committed at this point? I think that question actually came in before you went through your pipeline there, but maybe you can just kind of reiterate that.
Yeah, that's a great question. So the four that we had that I had displayed, these are projects that are currently in our due diligence process. So the fund through DLA Piper is really, I would consider it an umbrella fund, and the four that I had displayed are actually in due diligence right now. We're inking those documents now. but they're going to be they will be in our project or in our fund.
Good. Randy wants to know, when does the preferred return start? Is that at stabilization or sooner?
Yeah, great question. It's when you make the investment. So the moment that the investor is accepted into the program, let's just say it's a B share at 14%. We calculate that 14% from the day they get into the fund. So we would actually, of course, the big returns are at stabilization, but we start to calc the returns from day one.
Excellent. Let's see. This one is from an anonymous attendee. He or she asks, how are the investment returns segmented for each investor with customized selection within one qualified opportunity fund? Or does each investor essentially have their own customized qualified opportunity fund?
It's really the latter. You're almost customizing it for yourself. Quite frankly, the real question is, and the onus really falls on us, quite frankly, Jimmy, we have to figure out how to disperse the fund expenses properly amongst all the different projects. And that's why, one of the reasons why we have third-party oversight throughout the life of the program, because we need to give that to our third-party reviewer to make sure that we're distributing the expenses properly amongst all the different projects. But it's not an accounting hassle at all for us to distribute cash flow and returns project by project. The only real science to it is going to be dispersing the fund expenses, but we have a protocol for that.
Gotcha. This question, it was also submitted anonymously and came in while you were going over one of those projects with the different returns. And you mentioned the pro forma return at 15%. I'm not 100% sure what this question is asking, but it says, what is pro forma return? So I'm not sure if this person's asking for a definition of a pro forma return or what it is specifically to the fund.
I think I know what your viewer's asking for there. And I think I could probably do better on that slide too. What I'm saying on that slide is we have a preferred return for the project of 12%, but it's on the pro forma, it's currently at 14%. So as you know, you could throw out any preferred return you want. That doesn't mean the project's going to do that return. So I'd like to bifurcate the two and say, here's what our preferred is, but it's actually we're pro formaing this on a conservative basis to hit 14. So that's what that meant.
Makes sense. Yeah. Thanks for the clarification there, Greg.
You're welcome.
One more question, and then I'll cut everybody loose for a break here. Are there any projects for smaller investors with less than $50,000 to invest? And maybe you can speak to why the investment minimum is structured the way it is.
Yeah. So let me answer the question. First of all, the answer is yes, because it is a partnership and it really is up to the general partner's discretion. So there have been times, Kyle and I would discuss it and we would take in lower investments than 50,000. But generally speaking, you're talking about accredited investors, and normally anything above 50,000 and above is usually about the mark that really facilitates a good risk reward variance. But I can tell you right now, I've had people go into my programs at 10,000, as long as they meet the investment criteria. But generally speaking, program this size, usually the average investment is around 350 to 400,000. But the quick answer, because I know you want to get to lunch, is yes, we can take lower than 50, but we do have the minimum set at 50.
Awesome. Well, thank you very much, Greg. Thanks for your presentation today. For you investors out there who wish to learn more, please do visit usgre.com. They have a contact us form on their homepage there where you can fill out some information real quickly, and you'll receive more information from Greg and his team. Greg, thanks again.